Good morning, everyone. Welcome back to Retirement Plan Academy. I'm Zach Hurst with the Trust Company of Tennessee. Joining me from my team is Adam Davies. Adam heads up our retirement plan services out of our Knoxville office, and I am a certified financial planner out of our Chattanooga office. So I know we have some clients on the call who know who we are. Some might not. We are a financial planning firm out of East Tennessee with a major focus on helping plan sponsors like many of you find good retirement plan solutions. So we are here for further education after a nice summer off. Adam, I hope you enjoyed a couple months away.
Sure did.
Good. We've got some experts joining us today from JP Morgan, and we are very happy to have them here on a topic that is something that many of us know about, hear about, and have no clue what it's actually about. So they're going to break this down for all of us today. David Leibovitz is here. David is a global market strategist for the purposes of this call. David, you are the expert on crypto who's going to explain this to all of us who don't understand it very well. And Dan Nato is an ERISA strategist with JP Morgan. Those of us who come on these regularly have seen Dan with us before. Dan's an expert in the retirement plan space and is going to talk to us about the suitability or lack thereof of cryptocurrency within the space. So before we get started, a couple of, and you'll have to look at our faces for just a minute, I'm afraid, but a couple of housekeeping items. For those attendees, you're going to see a questions box on your screen somewhere. I think yours looks different than mine, but you'll see a box that says questions. You may have questions as we go. Please go ahead and send those off. I'm not going to read your name out or anything like that. Just a matter of making sure we get whatever questions you have answered. So ideally, I'm going to answer those as Dan and David are covering the materials and as your questions come in. If not, we'll leave time at the end to make sure that we get to those. So let me bring out my cheat sheet. There is CE credit that we're offering through this. This is for SHRM, HRCI, and CPE. So the requirements for this, we are going to have 3 interactive poll questions as we go, and we're going to launch the first one in just a minute. Please make sure you answer all 3 of those poll questions. You must stay for at least 50 minutes. Hopefully we're not going to keep you much past that, certainly not past an hour. And we are going to have an evaluation form at the end of this that you must fill out to receive credit per the requirements of those certifications. And for those of you who are going to receive the CE credit, we'll email that to you afterwards. So with that, we are about to launch into the presentation, but before we do so, Joanna is behind the scenes, and Joanna is going to launch that poll question number 1 that I just mentioned. And we'll get that up in just 1 second. And you'll see it coming open now. And let me get my view correct here. It says, do you personally currently invest in cryptocurrency? My answer is sometimes, and then I get out of it within about 3 days because I'm petrified of it. How about you guys?
That'll be a no for me.
I would say that I have indirect exposure because my wife works for a crypto company, so we're plenty of exposure in our household.
Well, in my case, I'm in the no category.
Yeah. And Dan, is that simply just too new and too volatile, or what's your reason for that?
It looks like I'm in the majority here.
Yes, you are.
Up on this call. I don't invest in anything I don't thoroughly understand, and David's tried to educate me over the years, and I'm still struggling to really get what these things are all about.
Well, just give it 20 minutes and I'll have this all figured out for us.
Okay.
Okay, so there you have it. Yeah, the poll results there. Very few of us actually do invest in this, but it's impossible to ignore it. And we've heard all the success stories of those who got in so early to it, and now a lot of us are thinking about coming in way later than that. And I think exactly what Dan said is the reason most of us do not, is we just don't fully understand it. So let's get to trying to understand this, at least the basis of it, and then we'll apply this to you on the call, the plan sponsors for plans, because you're probably hearing noise on your side from participants, maybe younger, maybe older, who knows, who are saying, can we get access to this within the plan? So good idea or not, Dan will cover that in a little while. So David, we'll start with you to kick us off and start to explain a little bit about cryptocurrency and walk us through this.
All right, great. Thanks, Zach, and good morning, everybody. Happy Thursday, and I hope you're all doing well. So in terms of my portion of today's conversation, I thought I would start by talking a little bit about why we believe that crypto has really captured the hearts and minds of the investment community over the course of the past few years in particular. I want to spend a bit of time talking about whether or not these are currencies, how do they differ from things like US dollars, and spend a little bit of time talking about Bitcoin, Ether, and some of the more commonly traded digital assets as well. At that point, I'll shift gears and spend some time on how we think about incorporating or not incorporating crypto within the context of a diversified portfolio, and then I'll wrap things up with a few thoughts on where things may be headed from here. So to start, just looking at this first slide, page 2 in the presentation, what we're looking at here is the price of Bitcoin back to 2016. We've actually had to show this on a logarithmic scale in order to capture the price volatility that's been observed during this period of time. And what I find so interesting about this chart is that there are multi-month periods where you can see the price of Bitcoin has risen, multi-month periods where you can see the price of Bitcoin has fallen, multi-month periods where the price of Bitcoin, frankly, hasn't gone anywhere, but over the course of the chart, the line moves up and to the right. And so it's really this combination of elevated volatility and seemingly an ability to get rich quick that we think has really captured the hearts and minds of the investment community. And again, particularly over the course of the past couple of years. Now, if we flip to the next chart, not only are people interested in what's going on here and asking lots of questions about it, but I think, one of the more important aspects is that they've simultaneously been voting with their dollars. Now, what we're showing here on this chart is the market capitalization of the top 10 holdings in the S&P 500. Those are the gray bars. The green bars represent the market capitalization of the 5 most commonly traded crypto assets. And what you can see when we marked the data at the end of July was that Bitcoin was sporting a market cap basically in line with that of Johnson & Johnson and United Health, Ether sporting a market cap about half that of ExxonMobil. But these numbers are increasingly difficult to ignore. At one point, Bitcoin had a market capitalization of $1 trillion, and Adam was actually asking me before we kicked the call off, like, how does this compare to the money supply of different countries around the world? Now, the United States, our money supply is, call it $21 trillion. So, kind of dwarfs what's going on in the crypto space. But if you look at a country like South Africa, their money supply measured in US dollars is about 225 billion. So one way to think about this is that the market capitalization of Ether is effectively in line with the money supply of a country like South Africa. So people they've been intrigued, they've been voting with their dollars, and as a result, crypto is coming up in pretty much every client conversation that we have. But I'm sure that a lot of you have been at a dinner party recently, a cocktail party. The topic of crypto comes up, and somebody from the back of the room shouts, well, we all know the value here is really in the underlying blockchain technology. And what I would say is that is an accurate statement, but what I've found is that very few people can actually explain what a blockchain is, how it works, and why it may or may not be valuable over time. And so if we flip to the next chart and just think a little bit about, what is a blockchain and why might it be valuable? In the simplest sense, a blockchain is nothing more than a database. And as everybody on this call probably knows, a database is a collection of information that is stored electronically. The biggest difference between a blockchain and a database is simply in the way that the data is structured. And so you think about a traditional database, say a workbook in Microsoft Excel, you have your data structured into rows and structured into columns. The only difference when it comes to a blockchain is, hence the name, the data is structured into blocks. And so, again, all blockchains are databases, but not all databases are blockchains. And it really comes back to the way that the information is being structured. Now, in the current environment, the primary use case of blockchains is to store cryptocurrency transactions, but there are a lot of other real-world applications that we've come across as well. And one of the best examples that I've seen of how a blockchain can be valuable kind of in the real world is the example of Walmart. So Walmart uses a blockchain for quality control in its produce business. Effectively, Walmart can track, say, a mango from the point in time at which they receive it from a farmer somewhere in the world to the point in time in which it is sold in one of their many thousands of stores. And you think about that quality control. You go back a couple of years. I'm sure everybody remembers the issue with Chipotle and the E. coli and the lettuce. It took them like a month to figure out where things had gone sideways. Arguably, if they had been using a blockchain, they could have figured out where things had gone wrong over the course of an afternoon. And so there is value here in this underlying technology, but how does a blockchain work, right? How does it process information? So college football season is right around the corner. Let's say Zach has tickets to the UT game, and I want to buy those tickets from him. And for whatever reason, he wants me to pay him using Bitcoin. The way that this all works is we start by broadcasting this transaction to the network of computers that are running the underlying Bitcoin code. Our transaction is then bundled with a number of other transactions, and these individuals called miners work to solve very complicated puzzles or equations, right? This is the crypto in cryptocurrency. It comes from cryptography. They try to come up with a solution to these problems, to these equations that, again, is unique to the group of transactions that they have bundled together. Once they think they've come up with this solution, they need verification from the rest of the network. This is something called proof of work. And effectively, 51% of the users on the network need to agree that the answer to the puzzle or the equation is actually the answer. Once you have that consensus, once you have that proof of work, the transactions are deemed to be legitimate. The block is chained onto the existing blockchain, and the whole process starts itself all over once again. Now, if we flip to the next chart, you've probably noticed that a couple of times here I've referred to these as being crypto assets rather than cryptocurrencies. And to me, my background is in economics. As an economist, to me, a currency is one of two things. It is a medium of exchange, or it is a store of value. The reality is that, well, one, I'm not sure crypto is a store of value. In the past couple of months have very clearly reminded us of that dynamic. In terms of a medium of exchange, the reality here is that I can't go downtown where I live in Connecticut and buy my morning cup of coffee using Bitcoin. And until I can, to me, these are going to be much more like assets and much less like currencies. But beyond that kind of traditional definition, there are a number of other differences as well that we outline in the table. You can see on the screen in front of you, starting with who manages it. We just talked about this in the context of Bitcoin. The network of computers that are running the code provide management in the world of crypto. Governments which issue currency obviously manage things in the world of fiat. When it comes to how these assets hold value, a Bitcoin is worth what somebody will pay you for it, right? Crypto is based entirely on the forces of supply and demand, whereas you think about something like the US dollar, and yes, interest rates matter, yes, economic growth matters, but it's really based on confidence in the issuer, right? It's the idea that a US dollar is backed by the full faith and credit of the US government. When it comes to securing these assets, again, the network of computers that verify every transaction provide security in the world of crypto, whereas third parties like banks and governments provide security in the world of fiat. And finally, are there physical bills or coins? Obviously, in the world of crypto, the answer to that is no. And although dollars and cents are fewer and further between than perhaps was once the case, they do continue to circulate throughout the global financial system. So if we jump to the next chart here, I want to talk. Please.
I'm sorry. Yeah, sorry. Just one question on this one. I'm interested by this. So somebody like me who doesn't track this very closely, I hear about these new coins coming out all the time, right? I've got Bitcoin or Doge or Ether or whatever these things are. And so when I'm looking at this chart and I see cryptocurrency and it says, can I buy things with it? And it says only where merchants accept it. So if I'm an investor or a plan sponsor thinking ahead, if this is going to be part of plans in the future, trying to figure out which one to bet on, am I betting on who can sell it the best, where it says only where merchants accept it, or how does that work?
So the way that I think about all of this, and we'll talk about it in more detail in just a little bit within the context of kind of the crypto ecosystem more broadly, but all of these blockchains provide different services, right? And so Bitcoin is really just a payment network. Now, the problem is the Bitcoin network processes something like 4 or 5 transactions per second, whereas Visa processes 5,000, right? So it's just not running at the same, it's not operating at the same scale as the big payment networks that exist today, and that's going to be one of the challenges. But that's specific to Bitcoin, right? When I think about crypto, I tend to think about it as being Bitcoin, which is used for payments, and then everything else, which is more used for the processing of information as opposed to monetary transactions. And so when I start to think about some of these other blockchains that, back to the example of Walmart, right, which provide better tracking for goods in the supply chain, arguably Walmart's bottom line benefits from that. And if there's a cash flow in the real economy that we can link to some service that a blockchain provides, now we can begin using more traditional financial methods to value these digital assets. And again, that's much more specific to the non-Bitcoin world of crypto. But with respect to how you should be thinking about it as an investor, the way that I think about it is, maybe at some point we can transact relatively easily using something like Bitcoin, but the real value is going to be in those other blockchains, and the associated tokens will therefore derive value from the benefit that accrues to a given individual or corporation from using the underlying blockchain service, if that makes sense.
It does, yeah, and that's a good explanation of what Bitcoin is versus the other. So I appreciate that.
And David, you used the example of buying UT tickets with Bitcoin. What do you think would have to happen between now and the future to make something like that possible?
So two things. One, and we kind of noted on this slide, there will only ever be 21 million Bitcoin. And so part of the challenge here is when you go to execute a transaction, again, buying those tickets using Bitcoin, you actually don't know the spot price with certainty of where that transaction is going to go through, right? You could buy those tickets, let's make it easy. Let's say you want $100 for 2 tickets. If I'm paying in Bitcoin, right, and let's say Bitcoin is trading at $50, well, do I pay 2 Bitcoin, right, because the mark is actually at 50, or does the volatility temporarily push it down to 25, and all of a sudden I have to use 4 Bitcoin to buy those same 2 tickets? And that really comes back to the inefficiency of the network. But once the full supply is available, one would believe that supply and demand would align, and we would find a more stable equilibrium price. So to me, that's one thing that would need to happen. The other thing is that the processing time is going to need to accelerate. I don't see myself, standing at the Starbucks counter waiting 15 minutes for a miner somewhere in the world to process a transaction just because I want to pay with Bitcoin, right? I'll double tap the side button on my iPhone and use Apple Pay and get out of there quickly so I can catch the train or get to my meeting, so on or so forth. So speed is one, volatility is the other. But if we can deal with both of those things, I can see a world where this becomes more widely accepted. Awesome. So maybe just sticking with Bitcoin specifically, as I've mentioned a couple of times, the Bitcoin ecosystem is simply the group of computers that are running the underlying Bitcoin code and storing its blockchain, which is the full transaction history. When it comes to storing balances of Bitcoin, this is where the term key comes into place. So if we go back to the example of buying those football tickets, basically we need 2 pieces of information. I need to know the public key, which is kind of like a bank account number, so I can send that crypto to the right place. And then Zach needs to use his private key in order to access the crypto once it has in fact been sent. Now, when it comes to releasing new Bitcoin into circulation, again, this is where the term mining comes into play. And as we talked about earlier on, mining involves solving these very complicated puzzles or equations, which validate transactions and create new blocks that are subsequently added to the blockchain. And, look, miners aren't doing this out of the goodness of their own heart. They're rewarded with Bitcoin for verifying these transactions, but that reward is cut in half for every 210,000 blocks that are mined. And so currently miners receive 6.25 Bitcoin for every block that they mine. The most recent halving, if you will, occurred in May of 2020. We think on average these halvings occur about every 4 years. And so by our lights, sometime in the middle of 2024, another halving will occur. And at that point, miners will receive 3 1/8 Bitcoin as opposed to the current 6.25.
So
finally,
one question
please,
I was thinking is that if there's going to be a finite supply of Bitcoin, how will miners be rewarded in the future? Will it be like a transaction fee, and the amount you pay, part of that will go towards the miner? Or right now, are they just getting extra Bitcoin because how does that all work?
So you bring up a very important point. So in addition to the new Bitcoin that a miner receives for verifying these transactions, they charge fees above and beyond that. And so once all 21 million Bitcoin have been brought into circulation, the reality is that miners will continue to charge fees. Maybe those fees increase, and they're not going to receive kind of that newly minted Bitcoin like they do in the current environment. Awesome. So finally, just on stable coins. So stable coins have been coming up quite a bit in the news. You know, regulators are very interested in getting their arms around that market. Stable coins are effectively the link between the world of crypto and the world of fiat. And so if I want to convert Bitcoin into US dollars, it's not as simple as walking up to the foreign exchange window at the airport and saying, you know, here's my Bitcoin, give me the fiat currency of my choice. There's actually an intermediate step whereby first I need to convert my crypto into a stable coin. These are assets that are backed one for one by dollars, euro, yen, so on and so forth, at least in theory they are. And then once I've converted to that stable coin, I can then convert to the fiat currency of my choice. But this is why regulators have been so focused on the stablecoin market. The reality here is that is the piping that connects the world of crypto with the more traditional financial system. And so if there's going to be contagion from crypto into kind of the global financial system as it stands, or arguably, if you were to see contagion move in the other way, it would pass through that stablecoin market. That's really the plumbing that connects the two. Now, if we flip to the next chart and think a little bit about Ether and the Ethereum network, we touched on this earlier in the sense that Bitcoin is just a payment processing network, and it's nothing more and nothing less. Ether and the Ethereum blockchain, in our view, is much more valuable and much more interesting. And not only can the Ethereum blockchain handle payments, but it can also store code, which powers things called smart contracts and decentralized applications, or DApps. Now, all a smart contract is a rules-based approach to processing information. And then the DApp is very similar to an app that you would have on your phone. It's basically the interface for interacting with that underlying smart contract. But we think that there's a lot of value in being able to take this algorithmic approach to processing data and information. I always like the example of my daughter. So my daughter's a little bit more than 3. I am constantly getting forms from camp, school, so on and so forth that need to be filled out by the doctor. I'm sure a lot of you have had a similar experience. You take the forms to the doctor because of course you can't email them. You give them the forms. They charge us like $40 to fill out the forms, which is kind of wild. And then it usually takes me calling 3 or 4 times and ends with me going to pick up the forms on the day that they're due so that my little girl can go off to camp or school, so on and so forth. What if in this crazy world of blockchain, you had a smart contract which basically knew the information that needed to go on the form? It could connect to my daughter's doctor's medical database, port in the required information, fill out the form, and deliver it to the interested party, all in a matter of minutes, right? When you start to think about the power of blockchain in that type of context, I think it becomes increasingly clear why there may be value in some of these parts of the crypto world and the blockchain world more specifically, that are really bigger than what we see going on in the world of Bitcoin. Finally, on Ether, a lot of you have probably heard about non-fungible tokens, or NFTs, as well as decentralized finance, or DeFi. Ether is the preferred form of collateral in the world of DeFi. So if you're borrowing, they basically want you to stake Ether as the collateral. And then when it comes to buying NFTs, the bathing ape is the one that's gotten all the attention, right? Justin Bieber isn't actually paying $1.2 million. He's paying using Ether, and that's the way that NFT transactions tend to be done. And so if we flip to the next chart, looking over at the plot, please.
One question here, David. So that sounds like a lot of jargon and a lot of new words that I hadn't heard pre-crypto. Who are the current people using this primarily? I mean, is it companies? Is it individuals? Who's using it today?
Who's using Ether, or who's using blockchain technology?
Blockchain, Ether, all of the above.
So what I would say is that Ether, as a payment system, right, is very similar to Bitcoin. And so we see retail folks primarily using the payment side of things. We do see businesses leveraging the ability to have smart contracts and these DApps, because again, going back to the case of Walmart, we do think there's value there. JP Morgan is another example, right? We use a blockchain internally for intraday repurchase activity with the rest of Wall Street. And so if Goldman Sachs wants to repo an asset for an afternoon, we can now do that, whereas it used to have to be more of an overnight or longer period of time between giving somebody the asset and then getting it back in your own account. And so to me, we're seeing corporate America begin to wade into the world of blockchain, but in terms of the payment side of things, that tends to be more the retail, the retail investor, the retail user. I think the best example is like if you look at something like Venmo or PayPal, right? You can now pay other people using crypto, and so that's where the payment technology has really been adopted, whereas the blockchain technology has been more of a corporate phenomenon.
And moving on to the next one before we do, David, I was going to give you credit. I think we've been doing this for 3 years now, and that is the first Justin Bieber reference we've had. So I wanted to congratulate you on that one.
I aim to please, and certainly want to keep it relevant and light. So, when you kind of take a step back and think about the world of crypto, the chart on the right-hand side, I think, is particularly interesting. What you see here is that together, Bitcoin and Ether account for more than 50% of overall crypto market capitalization. But looking over on the left-hand side, there are a lot of different digital assets out there, and I'm not going to take the time to go through each of these tokens and highlight what it is they do, but rather go back to something I said earlier, which is if you read through this, you'll see that all of these blockchains do different things, right? So the idea here is we think about blockchains as a service, right? They help with security of the supply chain. They help with tracking information. They help with shipping is a great example. So right now you have the captain with the big leather-bound book under his arm, kind of writing down which containers go off and which containers come back on. What if they were scanning a barcode, that information was going to the blockchain? All of a sudden, things wouldn't get lost in transit the way that they do in the current environment. And all of this is valuable in the sense that it, in theory, should boost the company's earnings. And so now, again, we've connected a service that a blockchain provides to a cash flow in the real economy. Just like when you think about owning a share of stock, right? The value of that stock is a function of a corporation's earnings. The value of some of these digital tokens is a function of the cash flow benefit that a given user can potentially derive. And so if we flip to the next chart, a lot of people will say to me, well, David, that's interesting, but at the end of the day, isn't this really just all about too much money chasing too few assets? Isn't it all about excess liquidity? And you can see on this chart, the blue line represents growth in the money supply. The gray line looks at the price of Bitcoin. You can see very clearly that particularly over the past couple of years, there has been a relationship between growth in the money supply and the performance of Bitcoin. But again, I think that there's more to this story than simply the liquidity aspect. And so if you believe or agree with me that there's something going on here beyond the Fed and the government just pumping a whole bunch of money into the market and that money then looking for a home, then the question becomes, well, how does this fit or how doesn't it fit within the context of a diversified portfolio? Now, if we flip to this chart, what you can see on the correlation matrix on the screen in front of you over on the far right-hand side is that we've added Bitcoin in. And looking over the past 10 years, Bitcoin has effectively been uncorrelated with every other asset on this page. And that's why people say, it's defensive, it's a diversifier. And yes, the aggregate data would very much validate that view. But what we found was that the devil was really in the details, and we wanted to be sure that these correlations, actually held over shorter periods of time. And so on the next chart, what we did was
David,
please.
One question before we move on. As I was looking at this chart, what really stood out to me, and Zach, if you can go back, that annualized volatility on the right-hand side. I look at things like large cap stocks, 15% annual volatility, and you scroll down to Bitcoin. That's a pretty big number. What do you think about that? 260%.
I think that we're going to get to that in a little bit more detail in just a moment, but I think that that's one of the challenges to optimizing the allocation, right? Is when you have an asset with a volatility of, I mean, even 100%, how do you think about incorporating that in the portfolio? This ties directly back to your question earlier about adoption, right? How are you going to use something to transact when you can't figure out what the price is going to be at any given point in time, given that volatility? And so we'll come back to the volatility issue in just a moment. Before we do, I want to wrap up my point on correlations. And so looking at this chart, what we decided to do was say, okay, how does Bitcoin, just as a proxy, interact with these other assets over time? And what we're showing here are rolling 12-month correlations between the S&P 500 in green and then the price of Bitcoin, and then the blue line represents the correlation between Bitcoin and inflation expectations. And you can see very clearly that sometimes Bitcoin moves the stock market, sometimes it moves with inflation, sometimes it moves with both, and then other times it does not move with either. And so on the next chart, what we did was said, well, maybe this is more of a defensive asset, right? People always tell me that this is kind of like digital gold, but the same challenge presents itself when you look at these rolling correlations between high quality bonds and Bitcoin in gray, and then Bitcoin and the price of gold in purple, right? Sometimes it moves with bonds, sometimes it moves with gold, sometimes it moves with both, and other times it does not move with either. And so if we flip to the next chart, and coming back to Adam, your point about volatility, when it comes to sizing an allocation within the context of a portfolio, you really need three pieces of information, right? You need some sort of expected return, you need some sort of expected correlation or covariance, and you need some sort of expected volatility. Well, let's talk about each of those in detail. So expected return, the return is based on supply and demand, right? So I can't really come up with a good estimate of what the return from Bitcoin will be over the course of the longer term. Thinking about the correlation, we just talked about how unstable these correlations have been. And so forecasting how this asset is going to interact with the rest of your portfolio is, again, very difficult to do. And then the third input to an optimization process is going to be volatility. You can see on this chart the elevated volatility of Bitcoin relative to the S&P 500 over time, and furthermore, the instability of that volatility, right? If it was stable at 260%, that would be one thing, but the reality is that it has bounced all over the place, and that has made it very difficult to come up with the right size for a given position. And so the smartest thing that I've heard anybody say about crypto is that if you're going to own it, you need to be prepared for the value to go to zero, because there is a non-zero chance that could potentially occur. So just wrapping up here, if we flip to the next chart, a few final comments. One is about the environmental impact. A lot of people like to say that Bitcoin is bad for the environment, and what we're showing here on this chart is the total amount of energy consumed by country. And then you'll see Bitcoin about 2/3 of the way over to the right-hand side. In 2020, the mining of Bitcoin consumed more energy than the country of the Netherlands. But very important to this is the fact that part of the reason why Bitcoin is so energy intensive is because of that consensus that you need to verify a transaction, right? Because everybody has to perform the same computation and then agree that the answer is the answer. What we're seeing more and more is that blockchains are moving away from proof of work and using something called proof of stake, where effectively, if I've done a good job validating transactions and processing information in the past, and that's going to be measured by my stake in the network or the amount of coin that I hold, I am more likely to be allocated transactions to validate an information to process in the future. The way to think about this, it's very similar to the banking system, right? Every month, I tell JP Morgan Chase who to pay and how much to pay them, and I let them take care of the rest because they have a good reputation for processing payments, right? Proof of stake is really not that different, where your reputation speaks for itself, and if you've done a good job in the past, you are more likely to be allocated transactions to process going forward. And so just wrapping things up here on the next chart, we've covered a lot today, and many of you are probably thinking, well, where do we go from here? The growth and adoption of crypto has been absolutely spectacular. As I mentioned earlier, it took 12 years for Bitcoin to hit $1 trillion in market cap. You can see in the chart on the right-hand side that the number of blockchain wallet users has effectively doubled from 2018 to 2020, and we believe that number continued to move higher over the course of 2021. We may well be in what a lot of people are calling a crypto winter today, but I do believe that the crypto and more specifically blockchain are going to remain firmly part of the investment conversation over the course of the years to come. And so with all that said, I will pause and Zach, pass things back over to you to continue on with today's conversation.
Thank you, David. Yeah, I really appreciate that, and good explanations throughout. And I feel like I know a lot more about it than I did 30 minutes ago, so I really appreciate that. What we're going to do now, and there's a few people who joined a little bit later, so may not have heard the intro here. If you are on for CE credit, or even if you're not, but if you are, it is mandatory to answer our 3 interactive poll questions. Joanna is behind the scenes. She's going to launch poll question number 2. Have your participants asked if Bitcoin is available in your retirement plan. And again, David and Dan, the audience here primarily are plan sponsors or those involved with their company's retirement plan. So this will be pretty interesting. I would think that it's probably come up, once or twice, wouldn't you?
We certainly hear that throughout the country, that that participants are asking the question.
Yeah.
And I know I've been asked that question several times, so I imagine it's probably come up quite a bit.
Adam, is that with the clients that we work with, or is that internally?
More so with some of the clients we work with, or even perhaps some that we don't, and they're just looking for different options available. So prospective clients.
Yeah. So the majority here have not yet heard this, and perhaps that's a result of what we covered on the first poll question is, are we ourselves investing? And the majority of us on the call are not. So maybe just people are still kind of afraid of it or don't understand enough about it. But regardless, it's gaining momentum. It's in the news all the time. So I'm sure that that's going to at some point flip a little bit. So I'm going to go through a couple of, David, I assume you don't want to cover all this. Is that fair to say?
I think we can skip the disclosures of the definitions. I think that's fair.
Perfect. Good deal. So as mentioned in the beginning, we're going to, in just a second, move to Dan Nato, who is our ERISA expert on here, and talk to us about what all this means for including this potentially in a retirement plan investment lineup. Before we do, let's launch poll question number 3, Joanna, and we can then cruise and wrap this up with Dan. So that poll is opening. Do you think cryptocurrency should be an investment option in 401k plans? Dan, I'll put you on the spot here. We work with a couple companies here, and they're more tech focused, and I don't know if that's by nature, but it's a younger workforce. Do you hear a lot more push from a younger workforce as it relates to crypto, or am I just making that up?
No, you're not. This is absolutely more of an interest among young people than it is people in my generation. In fact, I'm in the generation that The Who, when they came out with that song, My Generation, I was a young person at that time. So my generation, probably not. Younger people, more like.
Do you want to grab that guitar behind you and play that song for us real quick?
I don't have the right one back there. I need to call out that call.
Okay. So do you think cryptocurrency should be an investment option in 401k plans? Funny, this is actually the closest it's been, with more people saying that, yes, it should be an option. So clearly there's some interest there among those on the call. So Dan, let's let you kind of take us into this. We'll let Joanna close that out in 1 second. And let's start to get into what has happened so far, Dan, and then what's going to be coming ahead if you want to kick us off.
Well, I think if you were to ask the Department of Labor that same question that we asked of the attendees at this webcast, they would say not a good idea. In fact, what they came out with back in March of this year was what they call a compliance assistance release. And I want to be clear, this release that the Department of Labor came out with is not a regulation, it's not a law, it's not binding. If you violate this, you're not going to go to jail. But what the Department of Labor does from time to time is they come out with what's called sub-regulatory guidance. That is guidance that doesn't rise to the level of a regulation. And they do this a lot in the fiduciary area to advise fiduciaries, like a lot of you on this webcast, advise fiduciaries about some aspect of their responsibilities under ERISA. And they started off this 3-page release, which was written in plain language. It's not legalese, but they started off by reminding fiduciaries of what ERISA has to say about the fiduciary's duties. And the first thing they noted was that fiduciaries have to act in the best interests of their plan's participants. It's called the duty of loyalty under ERISA law. And they also reminded fiduciaries that they have to act prudently. And they noted that a lot of courts have said throughout the 47 years of ERISA, they noted that courts say that fiduciary duties are among the highest duties known in the law. So they kind of set that as a background, and they said, well, now we've got this thing called cryptocurrency that a lot of people are asking about, and it's really been quite popular. It's in the news, people are reading about it, and so on and so forth. But they said to fiduciaries, you want to be careful about adding it as an option in a 401k plan, because they noted serious concerns about whether it's a prudent investment to put on the plan's menu, and exposing participants to cryptocurrencies could be an issue and could be a prudence issue and a duty of loyalty issue. And they noted several reasons, a lot of which actually, David pointed out quite clearly in his remarks. But they noted that it presents significant risk of fraud, theft, and loss to participants' accounts because of, and they listed a number of reasons, the speculative and volatile nature. And we saw how volatile they are. We saw through David's charts how volatile they are. Quite frankly, I hadn't realized they were as volatile as David pointed out, but that's pretty impressive. And one of the things that I always take away when David speaks on this topic is you got to be ready for your value to go to zero, which, as an ERISA fiduciary, I think a lot of people have to take that into account. They also noted that the challenge for participants to make informed decisions. I've been reading about this stuff for quite a while. I don't feel I'm personally informed enough to make an informed decision about investing in it for my own personal account. If I were an ERISA fiduciary and were charged with making prudent investments available to my participants and beneficiary, I'd have even greater pause. Because custody and record keeping, where are these things custodied? Unlike a mutual fund, which is custodied by a trustee or a custodian, and there's a record keeper for the 401k plan who knows how to deal with the mutual funds and process mutual fund transactions and all that sort of thing. It might not be there just yet in the cryptocurrency world. Valuation concerns, about mutual fund gets valued every night at the end of the business day, and that valuation is transmitted to record keepers, and they can update my account and tell me how much it's worth, by 8 o'clock usually that evening. Is that the case with cryptocurrency? Who knows? And then, importantly, unlike the traditional investments we see in 401k plans, which are fairly highly regulated. Mutual funds are regulated under the securities laws. Collective investment trusts are regulated under the banking law and ERISA. We've got an evolving regulatory requirement with cryptocurrencies. I think we will get to more regulation and perhaps a more secure regulatory landscape for crypto at some point in time, but we're just not there. And the Department of Labor had another warning. Not only fiduciaries, you should think twice about adding it, but they said, if you do add it, you can expect to be audited by the Department of Labor. And I love this quote here, and I think fiduciaries should keep this in mind, and I quoted it on the slide. Fiduciaries should expect to be questioned about how they can square their actions with their duties of prudence and loyalty in light of the risks. So it was quite a stern warning. But I glossed over something that I have in bold and underlined on this slide. And this perhaps has caused the most confusion about this release, because the Department of Labor said not only if you're likely to be examined if you have cryptocurrency as an option on the plan menu, as a core investment menu option, but even if you offer crypto through a brokerage window. And one of the reasons why that reference to brokerage window has caused so much concern is the position that the industry and even the Department of Labor from time to time has taken, is that while plan fiduciaries have an obligation to vet the investment options that they put on the plan's menu, they don't have an obligation to vet all of the investments that are available to a participant through a brokerage window. Truly, the fiduciaries have to make sure that the brokerage window itself is prudent. By that, perhaps meaning that the vendor of the brokerage window is a sound vendor. They've got good processes and procedures. In addition, fiduciaries have to conclude that the fees that are charged through the brokerage window are reasonable. But beyond, is the vendor prudent and are the fees reasonable? Go looking through the brokerage window for all the investments to determine whether they are prudent. That has not been the position of the Department of Labor so far. However, when they came out with this and said, yeah, if you got cryptocurrency available in a brokerage window, that could be a problem. So this led to a number of a lot of pushback. If we go to the next slide, Zach.
And Dan, two questions on the last page. There's a lot of really good information on here, but if I'm a plan sponsor, one thing I might be wondering is, I make the decision, I want to add this. The Department of Labor has said you should now expect an audit from us within the next year, and you have to prove suitability. How would you even begin to do that as a plan sponsor? I mean, what factors would you consider? What would be a reasonable case to the DOL?
And here you've got a guy who's not a big fan of including it, trying to put out an argument for its inclusion. But let me try. I would say that, well, the nature of my company and the nature of my participants, we're a sophisticated high-tech company. Maybe we're a cryptocurrency platform that trades cryptocurrency. My people understand cryptocurrency. And I've done due diligence on the available crypto options that are available. And I have selected this particular crypto token and I made sure that all of my participants, whether they're the technical experts or the support staff, I made sure that we had adequate disclosure to all of them, and that disclosure was written in non-technical language. And so I'm very confident that my people understand it. So that's how I would build a case. But I cherry-picked a very select plan sponsor. Now, if I were a manufacturing company and most of my employees were say minimum wage employees, I might have a harder time making that argument that I just made and convincing the Department of Labor that it was an appropriate argument.
And that makes sense. One other question I had, and I was thinking about this when David was doing his portion, regarding the record keeping portion of it. He mentioned there's a public key and a private key. And I mean, just thinking of keeping track of all of that information and what if one key gets lost, I mean, I think that could expose a lot of liability. Would you agree?
Potentially so, and not understanding the ins and outs of how that all operates. If there's a possibility that something would get lost and therefore the participants not being able to access something they've invested in, that could be a serious problem.
And just for what it's worth, I think that's why custody is one of the bigger issues that's being discussed. And that's why there's a lot of conversation around when they do come out, and I think they will come out at some point with some sort of spot ETF, right? One that's based on the actual underlying rather than derivatives, right? That's going to clean a lot of this up, because then it's incumbent on a given provider to custody all of those digital assets, as opposed to John Smith, who loses his key and now his crypto is locked up for forevermore.
That's very helpful. Thanks, David. One thing I did not mention on the prior slide, the Department of Labor said, we've got issues with cryptocurrency and with respect to investments whose value is tied to cryptocurrency. So that broadens the list of investments that the Department of Labor is concerned with. What could they mean there? Could they go so far as to mean Tesla? Tesla is a company that said we'll take payments in cryptocurrency. I don't know, they may have reversed that stance, but the Department of Labor said no, we didn't really want to go quite that far. But maybe some firm who is a cryptocurrency trading platform maybe that the value of that firm's assets are tied to the value of cryptocurrency. So it's not just the crypto tokens themselves, but other firms as well.
That's a good point, Dan. And there's more and more ETFs and funds coming out, that are similar to what's included in a lineup. So there's going to be more opportunity for that, and that's a good point that you just mentioned on that side.
Thanks. Let's going to the next slide. I mentioned there was a lot of pushback when the Department of Labor came out with this guidance. Some industry trade groups, including the Chamber of Commerce, bankers associations, securities associations, and so on, said, wait a minute here. You didn't tell the regulated community that this was an issue, and now all of a sudden you came out with this guidance that we think you've gone too far. So they've urged the DOL to withdraw the guidance, but the Department of Labor is sticking by its guns. Senator Tuberville from Alabama, he specifically wrote to the Department of Labor questioning their stance on cryptocurrency and on limiting investment options potentially through brokerage windows. The Department of Labor again stood their ground, responded to Senator Tuberville saying, we're not doing anything new here. It's questionable whether that's the case, but nonetheless, they told the senator that no, we're sticking by our guns. But if you go to the next slide, that hasn't stopped record keepers from pursuing cryptocurrency. Fidelity announced that they're going to allow plans to put Bitcoin on the menu, make it available up to, and participants could invest up to 20%. Plan sponsor could dial that down and say, well, maybe we only want our participants to be exposed to 5%, so Fidelity would cap it there. For Us All, which is a record keeper that serves more of the smaller marketplace, they have an arrangement with Coinbase, which is one of these cryptocurrency trading platforms, and people would be able to invest up to 5% of their accounts through in investments obtainable through Coinbase, which presumably is a number of the various cryptos that David mentioned. The acting assistant secretary of EBSA, which is the unit of the Department of Labor that oversees ERISA, expressed, and the quote was, grave concerns about Fidelity's decision. Again, sticking to their gun. A couple of senators wrote to Fidelity saying, why are you doing this? Explain to us why you're doing this. A number of other members of Congress have asked the Government Accountability Organization, the GAO, to examine cryptocurrency. So there's a lot of activity in Washington looking at this. Should also point out that For Us All filed a lawsuit against the Department of Labor, saying that the Department of Labor overstepped its bounds. What they came out with in this compliance assistant release, this lawsuit argues, is tantamount to a regulation. And if you're going to promulgate a regulation, you have to publish a proposed regulation, give people the opportunity to comment, and so on. So that lawsuit was filed, I believe, in May of this year. So this is a continuing story. I want to point out one last thing, Zach, on the next slide.
Yeah, and before I jump there, Dan, I know you're wrapping up on that one, but a question on this. So Fidelity says it's okay to allocate 20%. It's the plan sponsor, let's just say they take that and they run with it, and then it goes to zero. It goes to zero, right? And so now there's lawsuits coming in everywhere. Can Fidelity say we're not a fiduciary? That was the plan sponsor's decision. I mean, who's on the hook for that?
Yeah, Fidelity would say that, and in most cases, Fidelity or any record keeper only performs ministerial functions. Fidelity would say, and most likely would say, we just made a service available to the fiduciaries of the plan, and they opted for it. We're not a fiduciary ourselves. We don't have any discretion or control over the assets of the plan. So we think Fidelity, if that lawsuit happened and Fidelity was brought in, we think Fidelity would prevail.
Okay.
So lastly, we mentioned Senator Tuberville, who wrote to the Department of Labor and was basically blown off. He said, okay, well, I'm going to propose a bill and file a bill in Congress that he calls the Financial Freedom Act. And what this bill would do, and by the way, it's there's no Democratic co-sponsors of this thing, so that's probably not likely to pass given that. But he said, well, you know, the law should not impose any requirements on fiduciaries to put any certain investments in a plan or prohibit them from selecting any investments. And then finally, no type of investment should be favored or disfavored by the Department of Labor. And then also that the investments available through a brokerage window, the Department of Labor should not prescribe or forbid any types of investments. So basically undoing through a law what the Department of Labor did through that compliance assistance relief. So again, this is an evolving story, I think, as David pointed out, and in the defined contribution arena, it also is an evolving story. I think in time, with more regulation, with more certainty and so on, we will likely see more interest in cryptocurrencies and plans, but right now it is kind of a tenuous situation.
Yeah, and Adam, I don't think we have a clear stance on this. I think just generally speaking for advisors on plans, you know, it's just it's hard to wrap your head around putting yourself on the fiduciary label for that for the reasons you've mentioned, Dan. And then just speaking to somebody who goes in and talks to participants, it's still so new and so speculative. It puts them in a tough spot, I think. So it'll be interesting to see what comes from that. Adam?
Well, and someone else who's taken a lot of calls from participants this year as the market's been down 20%, you know, I could just imagine those calls would be so much greater in volume and also in just emotion, you know, with the price of Bitcoin, you know, falling as much as 70% over the last year. So I think everything we talked today kind of gives an outlook of where it may go in the future. You know, if you get the volatility under control, the custody, the store value, the record keeping infrastructure. I mean, there could be a potential for it down the road, but I think there's a lot of uncertainty right now, especially given what the Department of Labor came out with in this notice.
Yep. And guys, we had 4 questions come in where I used my cheat sheets. I could tell you're going to be answering them on one of the next 2 slides when you introduce the subject. So we did cover the questions. Adam, one thing on this, and let me get through the disclosures, is if you want to just spend 1 minute on this, Adam, just know that you're the only thing standing between these people leaving early and not.
Great. Well, we'll still let you get out a little bit early, but did want to mention our next update will be Thursday, November 17th, fiduciary training. You know, we've done a lot of webinars over the last 3 years, and I thank a lot of you who have been regular attendees. We are trying to make this one in person, so if you have an appetite for coming down to our office in Bearden, would love to host you in person. But this could be a really good way to further that conversation around fiduciary responsibility that we kind of started here, and basically saying, you know, here's everything you need to know as a fiduciary, here's what you can delegate, here's what you can take off of your plate and perhaps put onto a provider. And so would love to host you Thursday, November 17th. And of course, we'll send invites as that gets closer.
Excellent. One final reminder, please answer the exit poll questions as you're leaving the webinar. Make sure you get that CE credit. We will send those out. David and Dan, you guys have been wonderful, very knowledgeable on this. We thank you so much for being part of this. Everyone have a great day, and we'll talk to you soon.
Thanks, everybody.